guys, what is going on? Welcome back to my Robinhood portfolio. Hope everybody is having a fantastic holiday weekend. Today I thought I would talk about how new investors can jump onto the stock market either through Robinhood or another brokerage account with as little as $100 per month. A lot of new viewers to the channel, a lot of new investors who don't have any stock market experience are a little bit hesitant, a little bit reticent about putting money into the markets because they're worried about losing all their money. A lot of you guys don't know exactly which stocks to pick, what time frames are best to buy and sell stocks. Also, a lot of emotions are typically used with new investors about buying and selling stocks. So to get around all of these extraneous influences and investing in a very solid strategy, a very safe strategy, I thought I would talk about dollar cost averaging. And this is actually a technique I've been using for the entire time I've had my Robinhood portfolio. It's a very solid technique, a very safe technique. And like I said, it gets rid of a lot of the extraneous decisions that need to be made with regards to which stocks to buy stocks, when to sell off. It's a very effective method that you simply put money into the markets and watch your money grow over time. So having said all that, let's jump into the portfolio here and talk about a particular stock that we'll be using with this strategy, VTV. This is a very good Vanguard fund. This is an ETF. Essentially, you buy this one stock, but you're buying an underlying portfolio of many different stocks. I believe this particular portfolio has 332 individual companies composed in it. So buying into the stock takes away one of the first decisions, what stock to buy. You buy into this particular stock and you have a very good portfolio of stocks. You have good diversification by simply buying this one stock. So really all you need to buy is one share of the stock each month at a fixed interval, and you are essentially doing dollar cost averaging. The other nice part about this stock as well is that it is a value ETF. It's essentially investing in companies that are considered value companies. And for new investors, a value company is simply a company, typically a blue chip company that has very solid fundamentals. That means it has a very good business operations, but maybe priced below its peers in its particular market segment. And there's a number of different metrics that are used to evaluate this, PE ratio being one of the top ones. I put out a few videos discussing how to evaluate companies, especially value companies, as well as PE ratios and a number of different other metrics, percent yield, net profit, so on and so forth. But suffice it to say that this company, or excuse me, this stock is invested in a number of underlying companies, 332 individual companies that are value companies. So you buy this one stock, you have good diversification, and you really don't need to worry about buying and selling individual shares of companies or selecting different companies to invest in. And the way dollar cost averaging works is you simply put in a set amount of money per month. And I've selected this particular stock because it's a very low cost ETF. I believe the cost is 0.06% per year, which is almost nothing. And it's investing in value companies, and it's just under $100. So if you have $100 to invest per month, you can buy one share of this per month, and you are essentially doing dollar cost averaging. And just to review what dollar cost averaging is, you simply buy on a fixed interval. So for example, over the year period here, you would have 12 different times in which you would buy the stocks. You'd maybe buy on the 1st of January, 1st of February, 1st of March, so on and so forth. And you're really not caring what the price of the stock is. You're simply buying one share per month at a fixed interval. And you're really negating the variability in the price of a stock. So the price of the stock may go up or may go down on any individual date, but by doing this very structured way of buying stocks, you get around the emotional appeal of buying a stock. If it's momentum trading, if it's trending down, so on and so forth, you simply buy on a regular fixed interval. And studies have shown this is a very powerful method, a very good method of playing the stock market, of investing in the stock market. You put $100 in, $100 in, $100 in, and if you do that consistently over a number of years, you'll build up a portfolio of a great stock that has a great return, and you're not worrying about market fluctuations, prices of the stocks going up and down, market factors, news. You're simply putting money into the market and letting the money work for you. Yes, after you get experience, you can start doing some more sophisticated types of trading, but this is a very, very powerful technique. And like I said, I've been doing this in my portfolio with a number of blue chip stocks that I'm using in a buy and hold strategy, and it's worked out very, very well. The other nice part about this particular stock is that it has a very good dividend yield as well, 2.474% paid quarterly. So not only will you have the benefits of dollar cost averaging, you'll also be getting a return quarterly as well with this particular stock, 2.474%. You can see it's a very large stock as well, 31.26 billion. So it's a very, very quality stock. It's a great stock, low cost stock. And by using dollar cost averaging, putting $100 in per month at a fixed interval, you're not worrying about if the stock is going up or down. Over the long term, you'll see a very nice rate of return without having, again, to necessarily worry about individual stocks, individual stock market decisions, if the stock market is going up or down, corrections, crashing, so on and so forth. You simply are putting money in at a fixed interval. And some of you may be asking, well, what happens if the price of the stock start tanking? What if there's a stock market crash? Well, if there's a stock market crash, let's see if I can't find a good part of it. For example, let's take this spanning from this time period to this time period. Let's say this represents a year. If the price of the stock starts tanking over the year, you're still buying at fixed intervals. So you're essentially buying the stock at a cheaper and cheaper price. So then once it starts rebounding, which you would hope over the long term that it will, and over time the stock market on average has given a net return of 7 to 9%, you'll start making an even better return on money. So yes, you did lose some money because you bought stocks when it was at this price here. As it trended down, you lost money on those prior purchases, but as it trended down, you're still buying at a regular interval. So no matter if this is a month or a year or 2 years, you're buying the stock at a cheaper and cheaper price. And over time, 10 years down the road, you'll have a very nice return when that stock will inevitably rebound. So that's the theory of dollar cost averaging. It works if the stock market is increasing or decreasing during corrections, during bear markets, bull markets. It really doesn't matter. It's a very powerful technique, a simple technique, and a technique any new investor can utilize, on the stock market. So I hope that makes sense. If you guys have any questions about that, let me know in the comment threads down below, and I'll try my best to answer your question. If any of the viewers have any added comments, please let me know. I'm always looking for great insight, commentary on the video. So that is stock market investing via dollar cost averaging in a very, very concise way there. Very easy, powerful method, very easy method for new investors to utilize. Essentially putting money in at a fixed interval. It doesn't have to be $100. It can be $50. It could be $100. It could be $200. You just have to buy a stock on Robinhood that is going to essentially match whatever you're putting into the market. So if you're putting in $200, simply buy 2 shares of this particular stock. If you're only putting in $50, you can select a different type of ETF. ETF that's in my current portfolio is SPHD. This is a quality index fund as well. And this is actually a monthly payment dividend stock, which is awesome for new investors. But if you only have $50, you can buy 1 share of this per month in the same method. You simply buy on the same date each month, no matter what the price of the stock is. And over the long term, whether the stock is in a bear market or bull market, over the long term, you should have a very good, very nice return when all is said and done. So that is dollar cost averaging. That is how I would invest on Robinhood for new investors. Not to make the video too long, I'll kind of end it there. As always, if you guys enjoy my videos, feel free to like, share, and subscribe. Building the channel, having a ton of fun putting out these videos. Hope you guys have been learning as much as I have been learning, researching the market, researching video ideas, comments, ideas from you guys. Definitely appreciate that. Keep those coming. If you guys have any great video ideas, let me know. And yeah, kind of with that, I'll end the video, and we'll see you guys next time.